Hello, welcome back. We're going to examine a company that was suggested by one of our subscribers. This one is C Limited and it is a company from Singapore, as you'll see here, SG. And the first thing to notice here is that the beta of the company is 1.38, which means that it moves at about 38% more than the overall market. So it's more volatile than the overall market by 38%. That is what this means. Has quite a few employees here, and it IPO'd back in 2017. What is interesting, and this is something that I generally speaking don't like to see with companies, is that they are engaging in a lot of different areas and very completely different with each other. Look at this, they engage in digital entertainment, e-commerce, and financial service businesses. So that's a lot of diversification here for one company and a lot of different segments and very, very different to each other. And that can really make the numbers of the company complex because when the company is handling digital entertainment and e-commerce, then they are your typical company. But when they are handling digital financial services, then they could actually be handling debt, and this can really, really skew our financials and our analysis of the company. And in this situation, if you are really into this company, it may make a lot of sense to actually take a deeper look and see what kind of credit the company is handling here, because credit can really, really mess your analysis and can really skew the numbers massively here. So if we take a look at the stock analysis tool here, which is what we're going to be doing next, you will see that the company has been going up and down quite a lot. You remember we saw that it is moving a lot up and down, that is 38% more than the overall market. So you'll see this kind of ups and downs from this company even in a month, as you'll see here. If we take it back to 5 years, you'll see that the company was much, much lower and it had a massive increase here and then a massive decline. And if you see the max chart, you will, yeah, that's the max, it's the max, it's a recent IPO. You will see that it actually is going down and down and down. Lately, it has lost 70% of its overall stock price. So what is going on with the financials of the company? Now the P/E ratio is negative, which talks about a company having negative earnings here, and the price to free cash flow ratio is positive, yet very high, and that's also a bad thing to see. Outstanding shares, look at this one, they are increasing massively and they are heading higher and higher over here, 170% higher than what it used to be 5 years ago. That's massive dilution here for a stockholder, and that's terrible to see if you are holding the company. And look at the free cash flow to total liabilities. Now they are generating so little cash flow that it would take them 54 years to pay all the total liabilities just using the free cash flow of last year. That's a lot of time. And yeah, you would want them to have a much lower number here. And again, this can be skewed from the fact that they could be handling credit, but it's one of their divisions. Remember that it's like 33%, if that is the case, if they are handling actually quite some debt here. But the revenue growth is at least very positive here, and it's growing massively. However, the net income is going down with the revenue growth going higher. And that's actually very concerning to see, because again, the main branches of the business have to do with digital entertainment, e-commerce. So this has to at least be positive here. I mean, how much credit would they be handling if they are that it would take them down to these levels and down and down and down? That would be weird, at least for the other divisions. Now the 5-year free cash flow growth is increasing from what it used to be, which is a good thing, but we will examine why. And the total equity growth here is also increasing, but this is probably because of them issuing shares and selling them to people. This is probably what happened here. Now, if this is a bank, really, indeed, which it is also, I was reading it like a digital bank, it's part of what it is. Their price to book ratio is high, and this is a core metric for a bank. Like if you are actually trying to establish whether a stock of a bank is a good stock, you would want them to have a low price to book ratio, because that tells you that the company has a lot of assets compared to the stock price, and this is what you can actually use to evaluate banks. This is what I typically like to use, for instance, and return on equity could be another one that is also negative here. So this is not looking great over here for the company. Let's take a little bit of a closer look at the income statement. Now we will see that the revenues have been increasing, and that's the good thing about the company, actually, that the revenues have been increasing. And the net income, however, has been going down, and this is the bad thing about it. There's there's a lot of decline, and you'll see that we are sitting at minus 2 billion here in terms of the company's net income. Company keeps on losing money, and if you take a look at the earnings here, they keep going down and down, as well as the operating income here. So that's definitely a worrying sign here for the company. Quite a few expenses as well is what you will see here, more than the gross profit. Okay, so the next one we're going to examine is the balance sheet, in which one we're probably going to see a lot of additional paid-in capital. I'm assuming, yes, 14 billion here, insane, as they were selling stock to stockholders, 8 billion here, massive dilution going on, and this is what makes this is definitely what makes the equity positive, as you'll see. It actually used to be negative a few years ago, back in 2018, and so they had to resort to issuing and selling shares to stockholders. This is probably why the stock went down so massively as well. This must have played a role. And the net income here is negative. For some reason, we don't have values for 2021 here. But the free cash flow is a little bit positive here. And this definitely has to do with the stock-based compensation for sure, and the other depreciation amortization fields here that do have to play a role for sure in order for this to be positive here, or other non-cash items that are probably one-time items that actually made this number positive, because the net income is negative, as we already examined. And if we take a look at the stock evaluation tool, and sometimes, because this is a Singaporean company, sometimes you are not getting the full numbers, and this is why you're seeing some of the numbers missing. It's an international company. And you will see here that the revenue growth that we can use could potentially be something like, let's just go with, this is not going to happen here for sure, but let's just go with, let's say 15. The company seems to be growing quite nicely, 20 and 23. This is good growth here. This is a lot of growth for our projections here. But I'm gonna try it for the next 5 years. The net income margins, though, look at this one. They are negative every year, and that's a horrible thing, because that will not really give us a positive number, really, because the company is not making net income. So we are still going to use something positive in order to get some numbers that make sense, 10, 15, and 20, but that's a massive leap of faith, as you can understand. And the free cash flow margin, we can use what they had in these couple of years, be around that area, 60, 70 and 80 maybe, and annual return that we typically want to make is 13%. Now remember that all these numbers are very, very aggressive here, super aggressive, just to see what the company is going to give us if we are super aggressive with our projections. Let's hit calculate, and you will see that even though we were super aggressive here, we are still getting a high of 97, and the current price is at 110. So I wouldn't really be surprised if the company goes down lower. And frankly speaking, I would probably really be cautious about even this number here. Again, because the company could have its headwinds, and I'm not sure whether they would be able to be profitable in the near future. So yeah, you're taking some risk if you are willing to buy this, especially at these levels, of course. But even at any levels, any of these levels here, remember how aggressive we were with our projections. All these levels here, I think, are fairly risky right now for the company. So again, it has to play a little bit of a role here if the company is getting debt because of its 1/3 of its business. That could be the case, so it could give us a little bit of a premium here. So you could actually maybe potentially even exclude like 33% of this and like add some premium on top, and say, okay, I'm willing to pay maybe 40 for my low here, or 35 maybe. But even then, we are very, very high from our current price, and also all the projections are very, 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 very aggressive here, super aggressive. So yeah, right now I wouldn't go with this company. I think it's very, very risky. And again, I don't really like that they have so many segments, so many different segments. I much prefer companies that are handling the same thing, and do not really, have branches and all sorts of different things. That's not really my thing. So I hope you enjoyed the video, and thank you for the suggestion. Hope it gives you some ideas. And if you did like the video, guys, please remember to leave a like and subscribe Very, very shortly, I will be giving you access to this tool. I'm doing some back testing right now. It's coming along well, and I think you're going to enjoy using the tool when you get access. And yeah, remember to subscribe, because I will let you know how to do that in a few weeks or so. Again, thank you for watching. I'll see you soon. Bye bye.